Chapter 4. Analysing Financial Statements. But history is neither watchmaking nor cabinet construction. It is an endeavour toward better understanding. Mark Bloch. Whoever wishes to foresee the future must consult the past. Niccolo Machiavelli. We can be almost certain of being wrong about the future if we are wrong about the past. G.K. Chesterton. Capital markets, in which investors make new and trade existing equity investments in firms, are different to, say, the Sydney fish market. The Sydney fish market trades in fish, which are delivered to you immediately and fresh. A fish might be swimming in the Pacific Ocean off Sydney's coast one evening, and its eyes may be looking up from a dinner plate in a terrace house in Sydney's Balmain the next evening. In a fish market, what you see is what you get. You get a fresh fish, which is typically consumed quickly. By contrast, capital markets trade in expectations. Expectations are people's imaginings about things that have not yet happened. Indeed, expectations will typically be people's imaginings about things that will never happen, at least not exactly as people might think they will happen. Equity investment in a firm involves predicting the future. An equity interest in a firm is not like buying a dead fish in the Sydney fish market. Firms are alive, and we are buying outcomes of their future business activity. Yet to predict the future, we need to start with the past. Machiavelli is a well-known Italian from the late 15th and early 16th century, who is probably most famous for his book, The Prince. His book provides pragmatic advice to leaders on managing the political process, that is, on gaining and maintaining power. Machiavelli understood the importance of consulting the past as the basis for being able to foresee the future. The English writer G.K. Chesterton pointed out that if we fail to understand the past, indeed if we are wrong about the past, we are unlikely to be able to predict the future very well. A firm's financial statements may be able to help us understand the past of a firm. To the extent they can, this may give us insights to be better able to predict a firm's future. Having a framework or a structure to view a firm and how it adds value to its equity investors can help us use financial statements to understand and make sense of our firm's economic and business realities. You've probably noticed a firm's financial statements can contain a lot of information. The discounted cash flow, DCF, and economic profit frameworks are two common frameworks used by people to analyse firms. These two frameworks help us to know what to focus on in a firm's financial statements as likely to be driving value in a firm, and what we can pay less attention to. Also, as we'll see in this chapter, viewing a firm as having separate operating and financial activities can be a most powerful way of viewing a business. The most efficient way to identify the key accounting drivers of economic profit and cash flow is to restate a firm's financial statements in a way that clearly separates the operating and financial activities of a firm. We will do this realistic task to help us learn more about financial statements. After you have restated the financial statements of a few firms, it can become a mechanical process for you. However, the first time you do it, you may find it somewhat frustrating and time-consuming. Remember the words about history from Mark Bloch, a French historian who was shot by the Gestapo during the German occupation of France in World War II for his involvement in the French resistance and for his Jewish ancestry. Like reviewing history, restating a firm's financial statements is an endeavour toward better understanding. It is not simply a task of putting together the financial statements in a different way, like putting together the parts of a watch or constructing a cabinet from various pieces of wood. It is a task we can do to make it easier for us to understand a firm's past. Indeed, the reason we'll be restating our firm's financial statements is to help us focus on and understand each item in our firm's financial statements. And we are not learning about restating financial statements. Rather, we will be restating our firm's financial statements to help us learn about financial statements. After we have done this, we will look at how we can analyse a key aspect of economic profit and cash flow, return on net operating assets, RNOA, by breaking it into profitability and efficiency. We will see that we can connect the accounting drivers of a firm's RNOA, that is, its return on net operating assets, with its economic and business drivers. This analysis is anything but mechanical. It requires us to engage with a firm's economic and business reality and is a subtle, creative, and active endeavour. You will find there are so many acronyms in this chapter, such as RNOA, FCF, and ATO. We use these acronyms to help us refer to the various ratios and other concepts in a way that is succinct and saves us from repeating their full names again and again. All these acronyms are a little bit like nicknames we might have for friends. And these can be difficult to cope with at first when we are just starting to get to know our new friends. To help you cope with all these acronyms, here is a glossary of terms. The glossary of terms gives you the definitions we are using in this chapter. Most people find it useful to print this glossary of terms and have it handy to help translate the acronyms in this chapter as you read the chapter. Here also is a summary of some of the key ratios and their acronyms that we are using in this chapter, which is based on the Penman-Nissen framework. And here is an acronym finder where you can type in the acronym and search for its definition. When using the acronym finder, remember there are no standard definitions of ratios and financial terms. There can be quite a bit of variation in how people calculate ratios and use acronyms. In this chapter, we'll gain some insights into how we can use a firm's financial statements to help us gain an understanding of a firm's past. Yet a firm's past is a trip already taken by equity investors. No one ever got rich by simply analysing the past. No one. Equity interests in firms involve us trading in expectations of an uncertain future. Yet, as Machiavelli said 500 years ago, whoever wishes to foresee the future must consult the past. In this chapter, we will do just that. Consult our firm's past. 4.1. How firms add value. Many of our strategies start with the premise that companies create economic value mainly by earning returns above their cost of capital. Andrew Lacey, Lazard Asset Management. Harris et al., 2006, page 57. How do firms add value to equity investors? All that equity investors receive from a firm are dividends. But when a firm pays its equity investors a dividend, this does not in itself add value to them. It is simply a transfer of value between a firm, which the equity investors already own, and its equity investors. We need to go deeper into a firm than this to find out what it is doing to add value, which then allows it to pay dividends to equity investors. As we saw in Chapter 3 above, since dividends and free cash flow, FCF, are related in a firm's financial statements, we can focus on a firm's cash flow rather than on the dividends it pays. In this section, we will look at some of the strengths and weaknesses of focusing on a firm's cash flow. We'll then look more directly at how a firm adds value by focusing on a firm's economic profit. Free cash flow. Instead of focusing on dividends, we can focus on free cash flow, FCF. However, looking at cash flow does suffer from some of the same practical problems as looking at dividends. The key problem is that cash flow, like dividends, is not in itself a measure of creation of value. Rather, it is also a measure of transfer of value. Dividends are a transfer of value between a firm and its equity investors. Similarly, free cash flow, FCF, is a transfer of value within a firm. It is a transfer of value between a firm's operating and financial activities. Free cash flow, FCF, is driven by two things: cash flow from operations, C, and net cash invested into a firm's operating assets, I. We have seen that the dividends paid to equity investors by a firm can be affected by a firm's dividend policy, which affects how much value is transferred to equity investors in any given year. In a similar way, the amount of free cash flow, FCF, a firm generates will be affected by a firm's decisions about how much to invest into its operating assets, I, each year. The more a firm invests into its operating assets, the less will be a firm's free cash flow, FCF, and other things being equal, the less will be the value of a firm under a discounted cash flow, DCF approach. At first sight, this does not seem to make much sense. Management of the firm are presumably investing in operating assets, such as building new retirement villages in the case of Ryman Healthcare, because they expect the additional operating assets will add value to equity investors and not reduce value. In other words, they expect the new operating assets, such as new retirement villages, to earn greater than the cost of the capital used to acquire them, rather than to destroy value for equity investors, as implied at least in the short run by the DCF approach. Let us look at an example. In 2021, Ryman Healthcare had operating income after tax, OI, of $644.9 million. This came from its operations in developing and managing retirement villages and rest homes in New Zealand and Australia, as well as selling occupation rights, which are a bit like leases, in retirement village units. This is the same as its operating cash flow, C, which we talked about in Chapter 3, Section 3.4 above. However, in 2021, Ryman Healthcare also invested $1,080.1 million into its operating assets as a result of a major building program of retirement villages and rest homes. We can call this investment in operating assets of Ryman Healthcare the change in net operating assets. Delta NOA, with the ancient Greek symbol delta representing change in. This is the same as its capital outlays, I, we talked about in Chapter 3, Section 3.4 above, where we also saw that free cash flow, FCF, equals C minus I. We can see that Ryman Healthcare's free cash flow, FCF, in 2021 was negative $435.2 million. This is calculated as $644.9 million, C, minus $1,080.1 million, I, as free cash flow equals C minus I. Alternatively, free cash flow equals OI, operating income, minus change in net operating assets. If we think of operating income as being operating cash flow and investment in net operating assets, delta NOA, as being capital outlays, I. However, if Ryman Healthcare had not invested so much in developing new retirement villages and rest homes in 2021, it could have increased its free cash flow, FCF. If it had only invested, say, $400 million rather than $1,080.1 million, it could have increased its free cash flow, FCF, from negative $435.2 million to positive $244.9 million. That is, free cash flow would have been $644.9 million C minus $400 million I, which equals $244.9 million. If Ryman Healthcare had in fact done this by reducing its investment into its operating assets, would it mean the value of Ryman Healthcare would increase? Quite the reverse, if you think its investment into operating assets is likely to provide a strong return in the future, that is, to add value to equity investors. This is a significant practical problem. Free cash flow, FCF, is a measure of transfer of value rather than creation of value. Yet many analysts in our capital markets focus on the cash flow of firms. So why would they do this? To get an idea of the value of looking at cash flow in a business rather than simply its earnings, let us first look in Table 4.1 at the forecast operating income over the next 4 years of two firms, King Enterprises and Marks Inc. Table 4.1, Forecasting Operating Income, OI. Year 1, Year 2, Year 3, Year 4. King Enterprises, 1,000, 1,100, 1,200, 1,300. Marks Inc., 1,000, 1,100, 1,200, 1,300. Which firm would you prefer to own shares in, King Enterprises or Marks Inc.? Well, based on the information above, we might think both firms are worth the same because we expect them to earn the same operating income in the future. But what if Marks Inc. needed twice the net investment in its business, that is, investment in net operating assets, than King Enterprises needed each year in the future to generate the same level of expected future operating income? Such an issue will be clearly captured in the expected future free cash flow, FCF, of the two businesses, as shown in Table 4.2 below. Table 4.2, Forecast Free Cash Flow, FCF. Year 1, Year 2, Year 3, Year 4. King Enterprises and Marks Inc. have the same operating income, but King Enterprises has net investment $300 each year, so it has free cash flow $700, $800, $900, $1,000. Marks Inc. has net investment of $600 each year, so its free cash flow is $400, $500, $600, $700. Which firm would you prefer to own shares in now? We see King Enterprises generates higher expected future free cash flow, FCF, than Marks Inc. Although both firms have the same expected operating income, King Enterprises expects to invest less each year to achieve the same earnings growth as Marks Inc. Expected future cash flow may give some insights into the value of firms that expected future operating income and, as we'll see later, expected economic profit may not. However, cash flow in any given year is not a good measure of a firm's performance. Indeed, cash flow is not a measure of value add for a period at all. As we discussed above, free cash flow could be easily increased at any given year by simply reducing net investment. By contrast, economic profit is a direct measure of value add in a year. Economic profit is based on a firm's accounting profit for a period compared to its cost of capital. To understand the value of the equity of a firm, we need to engage with the economic and business realities of a firm that are driving the creation of value by the firm for its equity investors. We can perhaps use financial statements to help us get closer to these realities by focusing on economic profit, which is the earnings generated over and above the opportunity cost of the capital the firm is using to generate those returns. Economic profit. One way we can measure the earnings of a business is return on net operating assets, RNOA. RNOA is operating income after tax, OI, divided by the net operating assets, NOA, invested in the business, including both working capital such as inventory and non-current assets such as buildings. RNOA can be expressed as operating income, OI, divided by net operating assets, NOA, the ratio relationship between operating income and net operating assets. This is the amount of operating income being earned, OI, for each dollar of net operating assets, NOA, invested in the business. We can think of RNOA as the return on capital employed or invested in the business. Economic profit is RNOA less the opportunity cost of capital times the amount of net operating assets. We can express economic profit like this. Economic profit equals brackets RNOA minus cost of capital, close brackets, all times net operating assets, NOA, where RNOA equals OI divided by NOA. Firms create value for their equity investors by earning a return on net operating assets, RNOA, greater than the opportunity cost of capital. And the more a firm can invest in net operating assets at returns above its cost of capital, the more value a firm can create. One of the things accounting leaves out is the cost of the capital the firm uses to fund its operations. Capital is never free. Its cost is the potential expected returns it could be earning in alternative uses. For example, a few years ago I bought a property in Yeppoon, Queensland. I invested some of my limited capital in it. I cannot now use that capital for something else, such as buying more shares in Ryman Healthcare. One thing about capital, you can only invest it in one thing at a time. Capital can only go on one journey at a time. It is the same with our lives. The true cost of everything we do in life is the alternative things we could have been doing with our time and energy and resources. Indeed, all of life is a trade. Because this opportunity cost is usually invisible to us, we often fail to consider it in life. If we were better at doing this, probably most of us would get a pretty big shock. We do not think about all the alternative lives we could have lived. We often fail to realize all the alternatives and options that lie before us, all the dreams, journeys and actions we could be taking instead of what we have chosen to do. It is the same with capital. By focusing on economic profit, we seek to include this opportunity cost of capital in our consideration of the business realities of a firm. Just as it is not easy to assess the opportunity cost of what we do in life, so it is also difficult to assess the opportunity cost of capital. Thankfully, not quite as difficult, as capital is at heart an impersonal commodity, which each of our lives is not. A firm adds value by taking capital from investors and using it to earn a return greater than the cost of that capital. Economic profit is a measure of the extent to which a firm has been able to add value over and above its cost of capital during a period. Not only dividends and cash flow are related, dividends and cash flow are also related to economic profit. The relationships are a little bit more complicated mathematics-wise, but take my word for it, it is possible to focus on cash flow or on economic profit, a measure of earnings, rather than on dividends. This draws on the same theoretical base as the discounted dividend model, which we discussed in Chapter 3, Section 3.4 above. The value of equity is the present value of expected future dividends. However, by looking at economic profit rather than dividends, there are several practical advantages. We no longer need to be concerned that the value of a firm will be affected by its dividend policy, nor by the amount of operating cash flow it reinvests into its operating activities in any given year. We can focus our attention and our efforts when analysing a firm's financial statements on those aspects that are potentially adding value. This may help us engage with the economic and business realities of a firm more effectively. We have seen that both cash flow and economic profit can play a part in helping us connect to how a firm is adding value to its equity investors. Before we start to use our firm's financial statements to help us understand its cash flow and economic profit, we will have a look at a powerful way of viewing business. This way of viewing business is to clearly separate in our minds a firm's operating and financial activities. Once we see how to do this, we will start using this way of viewing business reality to restate our firm's statement of changes in equity. In this way, we'll begin to see if our firm's financial statements can help us understand what is really going on in our firm. 4.2. Operating and financial activities. Business is not financial science. It's about trading, buying and selling. It's about creating a product or service so good that people will pay for it. Anita Roddick. A powerful way of viewing business is to view a firm as having separate operating and financial activities. And we'll see the most efficient way to identify the key accounting drivers of economic profit and cash flow is to restate our firm's financial statements. We do this to ensure we have clearly separated the operating and financial activities of a firm. We will restate Ryman Healthcare's Statement of Changes in Equity. In Section 4.3 below, we will look at how to restate a balance sheet and an income statement. There is no need to restate a firm's statement of cash flows, as we do not need this statement to identify the key accounting drivers of economic profit and cash flow. Before we start looking at how to restate our firm's financial statements, let us have a look at a potentially powerful way of viewing business by looking at a firm as having separate operating and financial activities. Operating and financial activities. We can view a firm as involving two distinct and different types of activities, operating and financial. A firm's financial statements include both aspects of a firm's business. By carefully separating these two types of activities in our firm's financial statements, we can more easily focus on understanding a firm's operating activities, which is usually where value is added or destroyed by a firm. We will see the power of having a picture of a firm in our minds that sharply distinguishes between its operating and financial activities. Like many people, you too may find it to be a powerful way of viewing business. It is a little bit like a Kinder Surprise, a small chocolate egg manufactured by Italian confectionery company Ferrero, which contains a toy inside. As children, we pester our parents to buy us a Kinder Surprise at the supermarket checkout. When they relent and buy us one, we eagerly rip open and quickly eat the chocolate egg to see what toy is inside. It is a little bit like this when we focus on the operating activities of a firm. The financial activities of a firm are the outside chocolate egg surrounding the toy inside. The toy is the operating activities, which is the part of the firm we are particularly interested in. Learning how to restate a firm's financial statements is a bit like learning how to rip open a Kinder Surprise and discover a firm's operating activities within. and from my perspective, just as much fun. As we carefully restate our firm's financial statements, we can separate our firm's operating activities from its financial activities. We rip open the chocolate egg of the outside company with all the distractions of how it is financed to see more clearly the firm's operating activities within. If you are a chocoholic like me, you could eat a small amount of chocolate, perhaps even a Kinder Surprise, while restating your firm's financial statements. This can give you an energy boost and perhaps remind you we are seeking to see a firm's operating activities more clearly when we restate our firm's financial statements. After restating our firm's financial statements, and while we may be jogging off the calories from the chocolate we may have eaten while doing it, we could reflect on whether this is a useful way of looking at a firm or not, and perhaps reflect on whether we should be eating less chocolate, or maybe not. A conceptual view of a firm. The best vision is insight. Malcolm S. Forbes. I spent a while ensuring I understood Figure 4.1, view of a firm. If I attempt to draw something myself, it forces me to understand it. So I created my own version of Martin's chart with all the abbreviations written out in full. After drawing the chart, see Figure 4.1 below, I could see why net financial assets, NFA, store value, as a firm doesn't use these assets in its operations, dealings with customers and suppliers. It was then explained that cash flow from operations, C, and net cash investment in net operating assets, I, are what is transferred between the net operating assets, NOA, and NFA of a firm. This concept was clarified when I saw that C minus I was equal to free cash flow, FCF, and that the transfer described is free cash flow. I remembered from earlier in the chapter that free cash flow is a transfer of value between the operating and financial activities, and I felt like the concepts were starting to come together and make sense. Rebecca Kirkpatrick. A powerful way of viewing a firm is to clearly separate in our minds its operating and financial activities. This view of a firm is set out in Figure 4.1 below. A more detailed view is provided in Figure 4.1a. This was prepared by Rebecca Kirkpatrick, a previous student in Act 11059, Accounting, Learning and Online Communication. The operating activities of a firm are its interactions with the product and input markets, with its customers and suppliers. These are shown in the left-hand side of Figures 4.1a. A firm's operating activities include decisions about which operating assets to acquire or to sell, and what agreements to make with employees, suppliers, and customers. It also includes various other activities that add value to the inputs a firm acquires from suppliers. For example, Ryman Healthcare builds retirement village units from the inputs from its suppliers and employees. The financial activities of a firm are its interactions with the capital markets, with equity and debt investors. These are shown in the right-hand side of Figures 4.1a. These include decisions about the financial structure of a firm, how much of a firm's operations to fund with debt or equity. It also includes matters such as dividend policy, how much of a firm's earnings to retain within a firm, and how much to pay in dividends to equity investors. This view of a firm in Figures 4.1a is worth having a good look at. This simple chart may well be the most valuable thing you learn from reading this entire study guide. It is worth spending time to make sense of it for yourself. In Figures 4.1a, you can see the firm is divided into two aspects: net operating assets, NOA, and net financial assets, NFA. On the left-hand side, net operating assets, NOA, are those assets net of liabilities that are used to produce products and services for customers in the product markets and earn operating revenue, OR, for the firm. They are also used to acquire inputs for a firm's operations from suppliers in the input markets and incur operating expenses, OE. The difference between operating revenue, OR, and operating expenses, OE, is operating income, OI. Figure 4.1, view of a firm operating and financial activities. Figure 4.1a, a more detailed view of a firm operating and financial activities. On the right-hand side of figures 4.1, 4.1a, we have net financial assets, NFA. These are those assets net of liabilities of a firm that are used to store value and are not used in the operations of a firm. If a firm's financial obligations exceed its financial assets, as is often the case, its net financial assets, NFA, will be negative, or in other words, it will have net financial obligations, NFO. NFA, or alternatively NFO, involve interactions by a firm with the debt and equity capital markets. These interactions involve net cash flow with equity investors, D, that is dividend payments, share issues and share buybacks. They also involve net cash flow with debt investors, F, that is net interest payments and the repayment and issue of debt. The operating and financial activities of a firm interact with each other. In figures 4.1, 4.1a, the transfers within a firm between its net operating assets, NOA, and its net financial assets, NFA, are represented by C and I. These are made up of its cash flow from operations, C, less its net cash investment in NOA, I. As we have seen before, free cash flow, FCF, equals C minus I. Also, we can express C as operating income after tax, OI, and I as delta NOA. In other words, free cash flow, FCF, equals OI, operating income, minus delta NOA, change in net operating assets. In figures 4.1, 4.1a, we can see a firm's free cash flow, FCF, comes from its operating income, OI, being OR minus OE, less any increase in its net operating assets, delta NOA. We saw in section 4.1 above that Ryman Healthcare's free cash flow, FCF, in 2021 was negative $435.2 million, which we calculated as Ryman Healthcare's operating income after tax, OI, of $644.9 million, less its increase in net operating assets, delta NOA, of $1,080.1 million. In other words, Ryman Healthcare's activities were using up cash of $435.2 million during the year. So how did Ryman Healthcare, with free cash flow of negative $435.2 million, manage to pay dividends to its equity investors of $110.5 million and pay net financial expenses, NFE, to its debt investors of $6.1 million? See table 4.8 below. Where did this cash come from? Well, Ryman Healthcare paid for this by increasing its net financial obligations by $551.8 million, $2,287.1 million minus $1,735.3 million. See table 4.6 below. After allowing for interest payments on these borrowings, Ryman Healthcare's net transactions with its debt investors, F, was $545.7 million, $555.8 million minus $6.1 million. Further, we saw that Ryman Healthcare paid dividends, D, of $110.5 million to its equity investors. In other words, free cash flow equals dividends, D, minus F, i.e. Negative $435.2 million equals $110.5 million minus $545.7 million. Figures 4.1, 4.1a shows us where free cash flow FCF comes from and where it goes to. We can see clearly that free cash flow, where free cash flow equals C minus I, is a transfer between a firm's operating and financial activities. Although we live in a world of less than perfect capital markets, the debt markets in Australia, New Zealand, UK, Europe, and in some other countries in the world are often quite close to being efficient. This means it can be difficult for a firm to add much value to its equity investors by way of its financial activities. Rather, it is through its operating activities that a firm primarily adds value. There can be considerable value in clearly separating a firm's operating activities from its financial activities to help us focus our analysis on the operating activities, where a firm has the greatest potential to add value to equity investors. It can be like opening a Kinder Surprise to reveal the toy of the firm's operating activities. But do not totally ignore the outside chocolate egg of a firm's financial activities. As we focus on the operating activities of a firm, we also need to have eyes in the back of our head, as we remember that financial activities can sometimes be very important. Just like the chocolate in a Kinder Surprise can be tasty and part of the overall experience of getting a Kinder Surprise. Statement of changes in equity. The statement of changes in equity shows how a firm's income statement and balance sheet interconnect. The bottom line or summary measure of a firm's income statement is net profit after tax. The bottom line or summary measure of a firm's balance sheet is the book value of equity. The book value of equity from the previous period's balance sheet plus the earnings for a period from the income statement should equal the book value of equity from the current balance sheet, after allowing for any cash flows between a firm and its equity investors, such as dividends paid to equity investors. However, this will only be the case if all the earnings of a firm are included in the income statement. A firm may not include some of its earnings in its income statement and instead include them in a separate statement of comprehensive income. These earnings are called other comprehensive income. Sometimes firms will show the income statement and statement of comprehensive income as a single statement of comprehensive income. The statement of changes in equity for Ryman Healthcare for the year ended 31 March 2021 is included as table 4.3 below. You will see there are columns for 2021 and for the previous year 2020. The restated statement of changes in equity for Ryman Healthcare for the year ended 31 March 2021 is included as table 4.4 below. Restating our firm's statement of changes in equity is usually quite straightforward. Ryman Healthcare's statement of changes in equity includes profit for the year, other comprehensive income for the year, and total comprehensive income for the year. These items are also included in Ryman Healthcare's consolidated income statement and consolidated statement of comprehensive income. See tables 4.7a and 4.7b below. In the case of Ryman Healthcare, restating its statement of changes in equity simply involves adding in a subheading transaction with shareholders and showing treasury stock movement and dividends paid as transactions with shareholders. I then provided a subtotal of total transactions with shareholders. In this section, we have seen a powerful way of viewing a firm is to clearly separate its operating and financial activities. We've also seen how to restate a firm's statement of changes in equity, which is usually a straightforward task. In the next section, we'll see how we can restate a firm's balance sheet to clearly separate a firm's operating and financial assets and liabilities. We will also see how we can restate a firm's income statement to clearly separate its operating and financial revenue and expenses. And remember, in our unit, the reason we are restating our firm's financial statements is to support us to carefully look at each item so we can be further introduced to our firm's financial statements.